Can you believe it? A veteran dealer was caught completely off guard, frozen in place, as the digital tickers flashed a number no one saw coming. Silver has just obliterated every resistance level to hit a staggering $78 an ounce. But wait, before you panic or think you've missed the boat, don't let this high price deceive you. The hidden truth behind this surge is about to shift your entire perspective on money. Is this a bubble about to burst or the opening shot of a massive global financial migration? Let's find out. Most people are panicking right now, convinced that silver has become far too expensive, but that's because they're only looking at the absolute number on the screen, while completely ignoring a silent, invisible enemy, inflation. To truly understand where we stand, we have to travel back in time. Let's look at the legendary peak of 1980. Back then, silver famously touched $50 an ounce. To the average observer today, $78 looks much higher than $50. It feels like we are in uncharted, dangerous territory. But is that actually true? Here is the aha moment most people miss. $1 in 1980 brought you a lot more than $1 does in 2026. If we adjust that $50 peak for over 4 decades of currency debasement and rising costs of living, the math tells a shocking story. To match the purchasing power of that 1980 peak, silver shouldn't be $78. It shouldn't even be $100. It would need to be well over $150 an ounce. Think about that for a second. At $78, silver is effectively trading at a nearly 50% discount compared to its historical high point when adjusted for the reality of the economy. We aren't looking at a peak, we're looking at a market that is still struggling to catch up with the massive amount of money printing that has occurred since the turn of the century. This is what I call the nominal illusion. The price tag says $78, but the value, what that silver actually represents in terms of global wealth, is still remarkably suppressed. But why does this gap exist, and why is it closing so fast now? In the video we just saw, Harry mentioned the jaw-dropping speed of the surge. That's happening because the market is finally waking up to the real value of hard assets. When you look at a loaf of bread, a gallon of gas, or a new car, those prices have all tripled or quadrupled since the 80s. Silver, it's only just now starting to move. If you use the official Consumer Price Index, or better yet, shadow statistics that measure inflation the way they did in the 80s, the results are even more extreme. By some metrics, silver at $78 is actually cheaper today than it was when it was $5 or $10 in the late 90s, because the dollar itself has lost so much of its soul. So when you see the headlines screaming about record highs, remember, they're talking about the price, not the value. The price is a reflection of the dollar's weakness, while the value remains an untapped gold mine, no pun intended. We're essentially watching a coiled spring. For years, the price was held down, compressed by paper trading and market manipulation. But as inflation continues to eat away at the foundations of the global economy, that spring has finally snapped. $78 isn't the end of the line. In the context of history, it's merely the starting block. If we were truly in a bubble, you'd see the inflation-adjusted price screaming past previous records. We're not even close to that yet. We're in the recovery phase, the part where silver finally demands its seat at the table alongside the rising costs of everything else. But inflation is only half the story. There is a new digital force driving this silver squeeze that didn't even exist in 1980. And that brings us to the real reason why the big players aren't just buying silver, they're hoarding it. If you think silver is just for jewelry or shiny coins in a dealer's showcase, you're making a massive mistake. The tech world is hungry for silver like never ever before, and the giants of Silicon Valley are starting to realize they can't build the future without it. We are currently witnessing a fundamental shift. In the past, silver was driven by investors and collectors like us, but today, a new player has entered the arena, and they have much deeper pockets. I'm talking about the industrial giants. According to the latest data from the Silver Institute, we're facing a structural deficit that has lasted for 4 consecutive years. But why now? The answer lies in 2 words: artificial intelligence.
Every single AI server, every high-speed semiconductor, and every complex circuit board required to process the data for ChatGPT or Gemini requires silver. Why? Because silver is the most electrically conductive metal on Earth. There is no substitute. If you want AI, you need silver. As tech companies scramble to build massive new data centers, they aren't looking at technical charts or waiting for a dip. They are buying because they must. To an AI firm, the difference between $30 silver and $100 silver is negligible compared to the risk of their multi-billion-dollar production line grinding to a halt. And it's not just AI. Look at the roads. The transition to electric vehicles is a silver black hole. A standard internal combustion engine uses about 15 to 28 grams of silver. An electric vehicle? It requires nearly double that amount for its complex electrical systems and battery management. Now, multiply that by the millions of electric vehicles hitting the road globally. Then, look up at the roofs. Solar energy is exploding. The photovoltaic cells that capture sunlight rely heavily on silver paste to conduct electricity. Even as engineers try to thrift or use less silver to save costs, the sheer scale of global solar installation is overwhelming those savings. We aren't just using silver anymore, we are consuming it. Here's the twist that should keep you awake at night. Unlike gold, which is mostly stored in vaults and recycled, a huge percentage of industrial silver is used in such small quantities per device that it is never economically viable to recover. When a phone is thrown away or a circuit board is scrapped, that silver is effectively gone forever. We are literally burning through the world's accessible supply to fuel our digital lifestyle. These industrial giants are now in a forced buy situation. They don't care about the gold-silver ratio. They don't care about what some analyst on TV says about a bubble. They care about physical delivery. This creates a floor for the price that has never existed in history. When industry demand becomes inelastic, meaning they buy regardless of the price, that is when you see a vertical move on the charts. We are seeing a collision between a finite, diminishing resource and an infinite, accelerating demand for technology. The silver in your hand isn't just a hedge against inflation anymore. It is a vital component of the 4th industrial revolution. But if the demand is so high, where is all this silver coming from? If the tech giants are buying it all up, what happens to the silver sitting in the vaults of New York and London? The answer is startling. It's disappearing. And it's not just going to factories, it's moving across the ocean to a new center of power. Let's talk about the great physical migration. While tech giants are quietly consuming every ounce of silver they can find, something even more dramatic is happening behind the scenes of the global financial stage. We are witnessing what historians may later call the Great Silver Migration. For decades, the price of silver was dictated by the Big Two, the COMEX in New York and the London bullion market. But if you look at the recent data from Reuters and exchange reports, a startling trend emerges. The physical vaults in the West are bleeding out. Stocks of silver in COMEX-registered vaults have been plummeting toward historic lows. And the reason isn't just industrial use, it's because the metal is physically moving east. The Shanghai Gold Exchange is consistently trading silver at a significant premium compared to New York. We're not talking about a few cents. We've seen silver in China trading for several dollars above the Western spot price. Ask yourself, why would someone buy silver in New York for $78 if they can immediately ship it to Shanghai and sell it for much more? This arbitrage is draining the Western supply. The East, led by China and India, is effectively outbidding the West for the world's physical metal. They aren't interested in paper contracts or digital IOUs. They want the actual heavy bars in their own vaults. This is a massive shift in the global balance of power. For a long time, Western banks could suppress the silver price by trading paper silver, selling millions of ounces that didn't actually exist in physical form. But you can only play that game as long as there is enough physical metal to satisfy the few people who actually ask for delivery. Now, that paper wall is cracking. When the Shanghai price stays higher than the COMEX price, it forces the Western markets to either cough up the physical metal they might not have or allow the price to explode upward to match the East. We're seeing the death of Western price manipulation in real time. This is why the reaction we saw from Harry at the coin shop is so significant. Local dealers are seeing the reflection of a global power struggle. If the East continues to drain the West's physical reserves, we won't just see a price increase, we will see a complete dislocation. We could reach a point where you simply cannot find silver in the West at any paper price. The smart money in the East understands something that the average Western investor is only just waking up to. Silver is the Achilles heel of the current financial system. By controlling the silver, they control a vital artery of both the tech industry and the monetary system. But here's the irony. While central banks and billionaire institutions are fighting this high-level geopolitical war, the average person is still worried about whether they are buying at the top.
They are looking at the $78 price tag and hesitating, while thousands of tons of silver are being loaded onto ships headed for the Orient. So the question isn't just about the global price anymore. The question is there any silver left for you? If you're watching the vaults empty out in New York, you might be wondering how you can still find a deal before the local shops run dry. Fortunately, the dealer's perspective we saw earlier gives us a secret roadmap. Even in a global squeeze, there are ways to find silver that the big institutions completely overlook. Let's get tactical. Let's talk about how to find the hidden gems in your local coin shop. With the global vaults emptying and the East outbidding the West, you might feel like you've been priced out of the game. But as Harry showed us at the coin shop, the smart money doesn't always buy what's on the front page of the news. When the market goes insane, you have to stop thinking like a speculator and start acting like a dealer. The most valuable tip Harry shared was about junk silver, also known as constitutional silver, and more specifically, those beautiful silver proofs. Here is where the math becomes your best friend. In the industry, when people trade old circulated silver coins from before 1965, they use a standard weight of 0.715 troy ounces per dollar of face value. Why? Because decades of handling and pocket wear literally rubbed the silver off the coin. But look at what was in Harry's tray. Those were proof coins, often broken out of mint sets. They have zero wear. Their actual weight is closer to 0.723 troy ounces. It might seem like a tiny difference, just a fraction of an ounce, but when you multiply it by hundreds or thousands of coins, you're getting an amount of physical silver for free that most people overlook. You are buying the actual as-minted weight, but paying the junk price. In a world of $78 silver, that small margin is a massive win. And here is the real insider secret Harry dropped. Many local coin shops are currently selling this 90% silver at or even below the spot price. Why would they do that? Because when the price of silver moves as fast as it just did, the bid-ask spread gets messy. Dealers who bought their inventory months ago at lower prices are often happy to take a quick profit and keep their cash flowing. While the big online retailers are charging 20 or 30% premiums because they can't keep stock, your local dealer might have a tray of junk silver they're willing to let go just to clear some space. This is where you find your hidden gems. Don't go looking for the fancy 5-ounce maple leafs that everyone is fighting over. Instead, look for the ugly stuff. Look for the Roosevelt dimes, the Franklin halves, or the modern silver proofs that someone broke out of a set because the packaging was damaged. These coins are 90% silver, they're recognizable, they're highly liquid, and they're perfect for barter if things ever get truly chaotic. They're the ultimate defensive silver play. You aren't paying for a collector's story or a limited edition label. You're paying for the metal, and you're getting more of it for every dollar you spend. But remember the warning from our research. Not all cheap silver is a good deal. Harry mentioned world silver, like 80% Canadian or sterling pieces. While they have more silver, they're much harder to sell back. Most dealers don't want to mess with the math of varied purities. Stick to what's sovereign and standard in your region. In a market driven by price illusion and global migrations, your goal is simple. Accumulate the highest weight of physical silver for the lowest possible cost. So, we've seen the shock at the counter, we've decoded the inflation-adjusted truth, and we've tracked the metal moving to the east. The pieces of the puzzle are all on the table. But where does this leave us for the rest of 2026? Are we looking at a multi-year bull run that will leave $78 in the rearview mirror? Let's bring it all together and look at the Minsky moment looming on the horizon. Everything we've discussed today leads to one inescapable conclusion. Silver is no longer just a side bet for hobbyists. We're looking at a strategic asset that has been fundamentally mispriced by history, and the market is finally correcting that error with a vengeance. While the headlines scream about a $78 peak, the reality of inflation, the insatiable thirst of the AI revolution, and the massive physical migration to the east suggest otherwise. What feels like the ceiling today could very well be the floor of tomorrow. We're moving out of the era of paper speculation and into the era of physical necessity. So, as we stand at this crossroads, the choice is yours. If tomorrow morning you wake up and see silver hitting $100 or even $150, as the inflation-adjusted math suggests, will you be the one smiling because you took action when the jaw dropped at $78? Or will you be standing on the sidelines, feeling that same regret many felt when they watched Bitcoin or gold leave them behind a decade ago? The vaults are emptying, and the giants are buying. What's your move? Let me know in the comments, do you believe $150 silver is our new reality, or do you think this is all just a well-timed trap? Don't forget to like and subscribe to stay ahead of the curve. I'll see you in the next analysis.